In Chapter 10, we're going to introduce three basic macroeconomic relationships. First, we'll look at the income, consumption, and income savings relationships. Then we'll look at the relationship between the interest rate and investment. And finally, we'll develop a multiplier concept relating changes in spending to changes in output. Our objectives for this chapter are to describe how changes in income affect consumption, list and explain factors other than income that can affect consumption, explain how changes in real interest rates affect investment, identify and explain factors other than the real interest rate that can affect investment, and illustrate how changes in investment or any one of the other components of total spending can increase or decrease real GDP by a multiple amount. We're going to begin with the relationship between income, consumption, and savings. So remember now that we're talking about disposable income, and we also call that spendable income, so it makes sense that that would be the most important determinant of consumption spending. Now, what is not spent is saved, so there's really only two things that we can do with our income. We can spend it or save it. So disposable income becomes that primary determinant of both of those. There is a direct relationship between consumption and savings and disposable income. When disposable income goes up, consumption and savings goes up. When disposable income goes down, consumption and savings goes down. We can look at this via a consumption schedule, and we'll look at that in a moment. Within that consumption schedule analysis, I do want to point out that when we're thinking about consumption spending, we're going to assume this is all planned household spending. We're not considering emergency type spending. So we'll have a consumption schedule that becomes a visual representation of the relationship between consumption and income, and then we'll have a savings schedule, which will become a visual representation of what's left over, right? So again, consumption savings have to add to disposable income. So we can also look at that as savings is going to be disposable income minus consumption. It's what's left over. We're also going to find that dis-saving can occur. That's when we're spending more than our income. So we're going to have to figure out how we can do that. So first, let's look at a figure that shows us this very strong direct relationship between disposable income and consumption spending. So what we're looking at here is data for the U.S. for the years 1987 to 2015. And you can see, first of all, that 45-degree reference line, that red line, that is where consumption equals disposable income. So you see that we have consumption on the vertical axis here, and we have disposable income on the horizontal axis. So the 45-degree line would represent those levels of disposable income and consumption where they're equal. The green dots represent actual consumption data for those years, and then the green line is a trend line that we have fit to those green dots, kind of smooth them out. So what we're seeing here is if we were to look at a particular spot, for instance, let's look here at 2005, all right? So we can see that we spent a little bit less than our income. The green dot is slightly below the red line. So anything between the green dot and the red line would be savings, okay? So again, what we're seeing here is that there's a definite relationship. And the other thing that I want you to notice is that just kind of in general, now we've got a recession in this data, so that kind of throws things off. But notice that as income gets higher, the distance between these dots of actual consumption data and the red line tends to get larger. So what we're going to find is that as income goes up, we tend to be able to save more. And that should make sense if you think about it. At lower income levels, necessities take up most of our spending. So there really isn't an opportunity, necessities take up most of our income. So there isn't much of an opportunity to save. But as your income goes up, those necessities become a smaller and smaller proportion of your overall income, which gives you the opportunity to be able to save more. So that's something we're going to look at in a couple of other graphs. Now this I want to show you is a graph from Fred. Let's go ahead and take a look at that. So what we're looking at here is personal savings as a percentage of disposable personal income. So the previous graph we were looking at consumption, and this is just looking at something slightly different. It's looking at savings as a percentage, right? So we're going all the way back to, I believe this goes back to 1947. So a couple things I want to point out here. Anytime we're looking at a graph in Fred, this is the Federal Reserve Economic Database, you'll notice we have these shaded areas. So Fred does this wonderful thing for us. It identifies recessions with these shaded areas. So here is the Great Recession, okay? And then here is the COVID recession, all right? So I want you to look at this graph and notice that although there is, a lot of variation from one quarter to the next, for the most part, the savings as a percentage of income, it seems pretty stable, right? For the most part of this data, it looks like it's falling in between 5% and 15%. Now, obviously, this is what we want to talk about, right? This is the COVID recession, and obviously personal savings does not follow the trend there. But I also want to point out the Great Recession. So I want you to see that there was an upward trend in the savings as a percentage of disposable income there. And then again, we can't avoid talking about the spike here. So actually, that's not all that uncommon, particularly in a more severe recession, because what happens is that even as people who aren't laid off, who are still working, who still have a job, but they're watching people all around them get laid off, they get concerned, and so they start saving more. Right? They think, well, we need to have some cash in the bank in case I get laid off. So it's actually not that uncommon, again, to see savings rates increase during a recession. Now, what was going on with COVID? And again, I think the reason this was such an outlier here is, again, there was everything about this recession was different. But one of the primary things that I think we're seeing there is that although we had a lot of people who were out of work due to shutdowns, and we had these COVID payments go out to try and help people, those COVID payments weren't targeted very well. So they were targeted by income level, but they weren't targeted whether or not you'd actually lost your job. So there were a lot of people who were able to shift to remote work and keep right on working and keep right on getting a paycheck, who were still getting these COVID payments. And so a lot of those folks stuck them into their savings, right? That was extra money. They put them in savings. And quite frankly, at the very beginning of the shutdown, it makes sense because a lot of places were closed and there were things we had previously been spending our money on that now we couldn't spend on. Now we figured that out, right, as the shutdown went on. But I think those two things together really helped to explain this spike in the savings rate. But again, outside of that, I want you to notice it's relatively stable. Okay, now let's go back. So here is another interesting visual for us. This is looking at the percentage of income that's saved. Now we're looking at it by income group. All right. So we've got the lightest blue here represents households that make less than 40,000. The next color up is 40 to 100,000. Then we have greater than 100,000, and that darkest blue is the overall rate. Okay. So again, this is kind of illustrating what I was talking about earlier. You see that for our families that made less than $40,000, 51% of those families didn't save anything, right? We understand that saving is very difficult when you have when you're at a lower income level, because you're spending more of your income on the things that really you have to buy. But so then when you get down here to these higher levels, notice, so here this blue is our highest income level. That's the greater than 100,000. So you see, as we get the higher levels, that's definitely standing out from the others. So again, what this is showing us is there there is a relationship between the level of income, the fact that as income goes up, we are now able to save, and so savings as a percentage of income goes up and consumption as a percentage of income goes down. All right, and this is taking a look at what we introduced at the beginning on one of the first slides, the idea of a consumption schedule. All right, so again, what we've got here, very similar to what we looked at before. We've got consumption on the vertical axis, and we have disposable income on the horizontal axis, and there's our 45-degree line. And we know that 45-degree line tells us where disposable income is equal to consumption. So we're spending everything we make. So now what we've added here is this consumption line. Okay, so this represents the level of consumption at that level of income. So looking here at I prime, at this level of income, notice the lower level of income, we can see that the consumption schedule is above the 45-degree line. That tells us that our consumption spending is higher than our income. When that happens, savings is going to be less than zero. Dis-saving is occur. So dis-saving is going to occur via borrowing, or if a household has assets, they may need to sell those assets. Okay. Then looking at a higher income level, this I sub 0, we see at that level of income, now the consumption schedule is below the 45-degree line. That tells us that we're consuming or spending less than our total income. So what's left over here is now available to save. So now savings is greater than 0. Okay. Now this last point here, just this income level labeled I, you'll notice that is where the two lines intersect. So that is the point where consumption spending is equal to income, and we call that the break-even point. It's break-even because there are no savings, but there's also no dis-saving. All right, this is looking at it a slightly different way. Ignore those propensity columns for a moment. Let's just look at columns 1, 2, and 3. So you'll see here that we start with our level of income, and we slowly get higher. So at this lowest level of income, here's our situation where we're spending more than our income, so we have negative savings or dis-saving. Then as income increases, first we increase to the point to where consumption is equal to disposable income. That would be our break-even income, where savings is 0. And then as income continues to increase, we see that consumption increases, but now we have some left over, right? So now we're getting into those levels of income where now we can save. So again, you'll notice that these two columns, consumption and savings, always has to add back to our level of income. Now we'll come back to those propensities here in a moment. So again, thinking about our consumption and savings schedules, because these are two parts of a whole, there is going to be a relationship between them. So first, let's look at our consumption schedule. Again, we've identified a couple of points. First, here's our break-even point, right? Our point where the consumption schedule crosses the 45-degree line. That tells us that consumption spending is equal to disposable income. So at higher income levels, the consumption schedule goes below that 45-degree line, which tells us we're spending less than our total income, which leaves some left over for savings. At a lower income level, where the consumption schedule is above the 45-degree line, that tells us that we're spending more than our income, so we've got some dis-saving there. All right. So this level of savings now is going to correspond down here on the savings schedule to this point. So the savings schedule is now oriented to the 0 line. So again, at break-even income, savings is 0. So that occurs right here. But once the savings schedule goes above the zero line, now we have some positive savings. But over here at these lower levels of income, now the savings schedule is below the zero line, so we have negative savings or dis-saving. Now let's talk a little bit about the consumption function. And don't worry, we're not going to be doing a bunch of complicated math here. But I just want to introduce this concept to you so you can see it and recognize it for what it is. So the consumption function is, as you see on the screen, C equals A plus BYD. C here is consumption. Okay, that's consumption spending. So what this is telling us is that the level of consumption spending is dependent upon that A, which is the intercept. It's dependent upon that B term, which is the slope of the consumption function, and then it's dependent upon disposable income. So let's think about that intercept point for a moment, that A term. That is the value of consumption where disposable income is zero, because if disposable income is zero, this term gets zeroed out, right? Well, how can you spend money when your income is zero? Well, you have to borrow, right, or sell assets. The other thing I want to point out to you is this B term. This is the slope. And this is the expected increase in consumption that results from a 1 unit increase in disposable income. So this is defining that relationship between disposable income and consumption for us. And what I want you to see is two things. First of all, notice that this talks about a change in consumption when disposable income changes. What do we think when we hear the word change? Marginal. The other thing I want you to point out, and we're going to come back to that. The other thing I want to point out to you is go back to this original consumption function. Okay, what does this look like? Hopefully you recognize that this is basically the equation of a line, right? And so this is the equation of that consumption line. Okay, I don't know why we call it a consumption schedule, and we could make it a lot simpler by just calling it the consumption line. Okay, so again, that consumption schedule, that consumption line, is determined by these things: the amount of spending when our income is zero, and then the relationship between a change in disposable income and a change in consumption, and that level of disposable income. All right, so now let's go back and talk about some of those propensities that you may have seen on that earlier slide. First of all, propensity is a $20 word. Propensity just means tendency, okay? So we're going to have average tendencies and marginal tendencies. So let's start with the average tendencies, the average propensities. First, we have the average propensity to consume. We call this the APC. This is the fraction of total income that is consumed, or the fraction of total income that is spent. Then we have the average propensity to save, or the APS. This is the fraction of total income that is saved. So here are your formulas. They're pretty straightforward. The APC is total consumption divided by total income. The APS is total savings divided by total income. So let's go back to the idea that there's only two things you can do with your income. You can spend it or save it. So consumption and savings always have to add to income. So because of that relationship, we know that these are two parts of the whole, right? So the APC and the APS have to add to 1, which makes the math a little bit easier, right? Once you calculate one of them, it's very easy to get the other one. You just subtract from 1. Okay? This is just, again, to put things in perspective for you, this is some data on the APC from 2018 for several countries that you would likely recognize. Now, we sometimes feel like we're a little spend happy in the United States, but I do want to point out, at least from 2018, look at Finland and Spain. Their average propensity to consume was over 100, right? Which means they were consistently spending more than they had coming in. Then we had Australia, Canada, Japan, and here finally we get to the United States. So we're more middle of the road, I think. So now we get to the marginal propensities. And remember, marginal, I want you to think additional or change. Something is changing now. So we have the marginal propensity to consume, which we refer to as the MPC, and this is the proportion of a change in income that is consumed or spent. Okay, so you have a change in income, how much of that change in income gets spent? Then you have the marginal propensity to save, the MPS. This is the proportion of a change in income that is saved. So again, what we're talking about here is a change in income, and that change in income can get split into consumption and savings. So the MPC is calculated as the change in consumption divided by the change in income. And the MPS is calculated as the change in savings divided by the change in income. So because the change in consumption and the change in savings have to add up to the change in income, we also have this relationship. The MPC plus the MPS must equal 1. Now, let me caution you, okay? The A's and the M's do not play together, right? And again, if you'll notice, when we calculated those, the bottom of the fractions were different, right? One was total income and one's a change in income. So they are not measuring the same thing, so you can't have the APC plus the MPS. It just doesn't work. All right? All right, let's do a little practice with our average and marginal propensities. So just to remind ourselves, our formulas here, the APC is equal to total consumption divided by total disposable income, and the APS is equal to total savings divided by disposable income. The MPC is equal to a change in consumption. Remember, the delta symbol stands for change, divided by change in disposable income, and the MPS equals the change in savings divided by the change in disposable income. And also we have these relationships, the APC plus the APS equal 1, and the MPC plus the MPS equal 1. All right, so in year 1, first of all, recognize that we cannot calculate the MPC and the MPS because nothing has changed yet, right? So in year 1, the APC is going to be total consumption, which is 80,000, divided by disposable income, which is 90,000. So that works out to 0.89. The APS would be total savings divided by disposable income. So that would be 0.11. Now, once we had the APC, we could have very easily subtracted from 1 to get that number. All right, now in year 2, let's go back and calculate our average propensities first. All right, in year 2, our total consumption is 88,000, and our disposable income is 100,000, which makes our APC 0.88. Our savings is 12,000 divided by our disposable income. So that works out to 0.12, which again, we could have easily just subtracted the APC from 1. Now we can calculate marginals because now something has changed. So our change in consumption is going to be 8,000 because we're going from 80,000 to 88,000. Our change in disposable income is going to be 10,000 because we went from 90,000 to 100,000. So our MPC is 0.8. Our MPS, the change in savings divided by the change in disposable income. For savings, we went from 10,000 to 12,000, so the change is 2,000. Our change in disposable income is still 10,000. So our MPS is 0.2, which again we could have easily calculated simply by subtracting our MPC from 1. Now in year 3, total consumption is 110,000 Disposable income is 125. So we have an APC of 0.88, which means we can shortcut and calculate our APS. That's easy. Now our MPC, our change in consumption, is now going to be 110,000 minus 88,000. So our change in consumption is 22,000. Our change in disposable income is 25,000 because we've gone from 100,000 to 125. So our MPC is 0.88. And again, to calculate our MPS, if we want to take a shortcut, we can just subtract that from 1, and we get 0.12. So this is really simple math as long as you remember the relationships. All right, one more thing I want to point out to you about the consumption and the savings schedules. So remember that when we looked at the consumption function, we talked about the slope, okay? And the slope defined that relationship between disposable income and consumption. Well, how do we measure slope? How do we determine slope? Slope is rise over a run, right? Well, look here. In this graph, the rise is consumption. The run is disposable income. So the rise is the change in consumption. The run is the change in disposable income. So our MPC actually is determining the slope of that consumption schedule. So our MPC, again, is defining that relationship between when income changes, what happens to consumption. Also, if we look at the savings schedule, the change in savings is the rise. The change in disposable income is the run. So the MPS now becomes the slope for the savings schedule. Kind of cool, huh? All right, so we have said that when it comes to consumption, spending, and savings, the amount of disposable income is the primary determinant. However, there are some other things that can cause consumption spending to change. So we call them non-income determinants. Those non-income determinants are things like wealth, borrowing, expectations, and real interest rates. So let's talk about these briefly. First of all, wealth. And a lot of students are confused because they say, well, but you said this is non-income. Wealth includes income, but it is not limited to income. So wealth is a larger concept. So wealth would include the value of assets like your home, your car, other investments, stocks that you may own. So the idea here is if you feel wealthier, you tend to spend more. And if you feel less wealthy, you tend to spend less. Okay, this is where we get kind of close to psychology. So we see this pretty often with stock market values. So when stock market values go up, let's say that you own 100 shares of a particular stock and it's priced at $10. So the value of your stock portfolio is going to be $1,000, right? Okay. Now let's say the stock market goes up and the price of your stock goes up to $20. Now the value of your stock portfolio is $2,000. You haven't sold any stock, you haven't actually made that money, but you feel wealthier. You might say, woohoo, look at this, let's go out for steak, right? But on the other hand, it works both ways. Let's say the price of your stock takes a nosedive and falls to $1. Now, without selling that stock, without realizing the loss, you feel much less wealthy and you tend to spend less. Okay, we call that the reverse wealth effect. Household debt can affect our feelings on spending. If we manage to pay our debt down, we feel like that weight is lifted off of our chest and we tend to spend more. But if we have a lot of if we have a lot of debt weighing us down, that can definitely have a psychological effect and we tend to spend a lot less. expectations. Hopefully you're starting to understand that expectations can be very powerful in the economy. Changes in expected future prices, we've already talked about with regard to demand, but can also affect consumption spending. Also, changes in expected future wealth can affect consumption spending. So I tell a little story on myself. Back when I worked in the corporate world, most corporations have an annual performance review, and based on your performance review, you're given a raise for the year, hopefully, right? And so, I would usually have my performance review late January, early February. And at that time, I would be told what my percentage raise was going to be for the year. So I had an idea how much my paycheck was going to go up. The catch is that my paycheck didn't actually increase usually to the end of March. So there's usually at least a month, maybe 6 weeks between the time that I was told what it was going to be and when I actually started getting the money. But I'll be honest, I immediately started spending that money. I immediately felt as though my paycheck had gone up, and I started spending that money even though I hadn't gotten it yet. And that was pretty common. On the other hand, and this is similar to what we just talked about earlier, if we were undergoing a lot of layoffs, right? And you hadn't been laid off yet, but you knew you might be next, then your expectation was that your wealth situation could be going down in the future, so you might cut back on your spending. And then the real interest rates relate to the incentive to borrow and spend. So if interest rates go down, that makes it more attractive to borrow money and spend it. So that would cause spending to go up. And if interest rates go up, then that makes it more expensive to borrow and spend, so spending goes down. So, that's, on the surface, the relationship we see with real interest rates. Now, I will point out that low real interest rates, which incentivize us to borrow and spend, can over time kind of creep back in with that heavy debt burden that now affects us, like we talked about with the borrowing aspect. So those are somewhat related. Now, in terms of just the overall effect on consumption spending, a lot of normal everyday household expenditures are not really interest sensitive. Things like your utilities, groceries, things like that. So the effect of interest rate changes on spending do tend to be modest. All right, a few other things that we want to talk about here. You may have noticed back when we looked at that slide that had the columns of information that it basically said GDP equals disposable income. At this point, we are really making that shift into the more macroeconomic world. So macroeconomic models focus more on real GDP than on disposable income. So from here on out, we're going to be speaking in terms of real GDP. Yes, we know they're not exactly the same, but what we find is we have similar relationships. Okay. Changes along these schedules, along the consumption schedule and the savings schedule. This is very similar to the concepts we talked about with a change in demand versus a change in quantity demanded. So when we have a movement from one point to another point on a given schedule, it's called a change in the amount consumed, and that's caused by a change in income. A shift of the schedule, if that entire line goes up or down, that's called a change in the consumption schedule, and it is caused by one of these non-income determinants of consumption. When we're talking about those lines shifting, the consumption and savings schedules, they will always shift in opposite directions unless a shift is caused by a tax change. So again, normally, because consumption and savings have to add to disposable income, if consumption goes up, savings has to go down. Okay? But when we're talking about taxes, taxes affect both schedules in the same way. So lower taxes will shift both schedules up because taxation affects both spending and savings, and higher taxes will cause both schedules to shift down. And then finally, in terms of the stability of these relationships, economists do believe that the consumption and savings schedules are generally stable unless deliberately shifted by government action. And again, that kind of goes back to what we saw when we were looking at the percentage of disposable income that is saved, and we saw that huge jump with the COVID recession. Again, remember, we associate that with government action. We associate that with those COVID payments. All right, here's what we're talking about, and we're talking about the curves shifting, okay? So this would be caused by one of those non-income determinants. So if we start here at C sub 0 and let's say our wealth increases, we feel wealthier, then the consumption schedule shifts upward. But if we feel less wealthy, let's say we've had a stock market crash, then the consumption schedule would shift down to C2. Now, again, normally when the consumption schedule shifts up from C0 to C1, we would see the savings schedule shift down from S0 to S1, okay? And if the consumption schedule shifted from C0 to C2, then we would expect the savings schedule to shift from S0 to S2.